Hi everybody and welcome along to the Mint monthly update for the single sector funds. It's just myself, David Fyfe, here today with John Middleton, portfolio managers, just reporting on the month of February that was. Just rolling through the disclaimer into the month. There's been a lot of big topics and very thematic outcomes in the last sort of 6 months that have driven markets. We've talked a lot about AI and what that's meant, and that, to be honest, has still continued. But I guess the more recent event that's driven a lot of noise in markets, especially offshore, has been the US and Israeli attacks in Iran and what that has meant in terms of, I guess, geopolitical instability, but also oil prices really been the key focus now. I say this and put this in front of you at a time when even today we've seen oil move about $20 a barrel within a day. So certainly volatile times, to say the least. But just looking back in history, the chart on the left there from a UBS presentation, I thought was quite interesting. Looking at over traditional, historic events like this in terms of military action, the oil price itself has normalized within 4 to 5 months normally. Now we're sort of seeing, and it might be quicker. It's certainly, if you believe what Trump's saying, it might be. But just in general, even as these things have continued, like the Russia-Ukraine war, and sometimes oil actually does normalize reasonably quickly. And interestingly, it's a similar chart in terms of an inverse one for markets, which is often within a short while it does tend to normalize. Now, I guess one of the interesting pieces I thought, every time it is different or there's different drivers. But the chart on the right there, looking at the surplus supply, it's almost never been bigger, but it's certainly excess supply versus demand at the moment in the global oil market. So there is some room for absorption within that, but clearly certain markets, like for example Japan and a few others, are heavily reliant on the Strait of Hormuz, where a lot of the almost all of the Iranian oil goes through. So there is some major shocks that continue to happen there, and I guess the other persistent point there is really just what does it mean from a second order effect in this part of the world. One thing we're looking closely at is, of course, what that means for CPI and what it means for the price of petrol at the pumps here. And it certainly can impact quite negatively names like Air New Zealand. We've seen the crack spread on, which is for jet fuel, the refinery spread has blown out quite heavily. And if that stays where it is, it's certainly going to hurt New Zealand almost sort of $4 to $5 million a day. So it is material. And obviously, even at Auckland Airport itself, you do have some planes grounded. And then on the flip side, you do have names like main freight, which sometimes can benefit from higher freight rates, as we sometimes see in global markets. So a bit of noise. And then the more wider macro one, of course, is what does it mean to rates with a higher CPI? And also some sectors like industrial as well that are influenced by fertilizer tied to this. So a lot of moving parts. No one's got the exact crystal ball answer, but something we're watching closely, and more specifically what we are watching is really around the refining capacity and what that means. So yes, certainly a watching brief there and interesting. In terms of closer to home in the funds, the fund and the index for the month of February was positive, reasonably strong month overall. It was a reporting month, and within that, we did see a lot of action in terms of 31 names from the 50 reporting. So it's a good broad spread. And in general, it was actually a reasonably solid reporting period. It may not have felt that way. There's certainly a bit of noise with markets softening globally at the time. But the chart on the right there sort of shows that, for the first time in quite a few years, we actually had net positive in terms of upgrades versus downgrades in terms of revisions as well. It wasn't too bad. So actually, in terms of earnings numbers, the underlying was reasonably broad spread, was actually decent. The gentailers certainly were a big part of that with higher lake levels in general. And I guess the key feature of that, of course, was we saw 2 large capital raises. One from Genesis, in terms of with the government support as well behind its 51% share, and also Contact. And I guess the key theme across those 2 names, as well as Meridian and Mercury, which reported, was actually a big uptick in expectation around investment pipeline and projects are pulling ahead with, and obviously require some funding for those. So that was certainly a big driver, and certainly saw funding within the New Zealand market that drove that. In terms of names in the funds and sectors that didn't do so well, was actually retirement. We did see a bit of a sell-off there, and partly driven by the softening or the non-recovering New Zealand housing market continues to sort of bounce along the bottom. And again, there was a bit of hope that summer might see a bit more of an uptick than we have, but yet to see that. So we'll see how that tracks there. And other names, we did see some good updates out of a couple. A2 was clearly one I think we touched on last time, but was outstanding in terms of its execution. Given the China birth rate soft, it's certainly did well in its infant formula business. Another one on the small end of town was Scullerup done particularly well in terms of its industrial and agri businesses, continue to do well in their rubber goods. One that continues to benefit as the tariffs have been unwound in part by Trump. And outside of that, one of the softer names was Serco, and in fact we've just had an update today on their outlook, and it looks like in terms of AI, it's not all defeat as the share price might imply, but it's one we're keeping a close eye on in general from there as well. So yes, as I said, a reasonably constructive reporting season. In terms of additions and change in the fund, continue to add to some Sky TV on weakness. A little bit of Vista again on the was another name that actually performed reasonably well post its result. Again, it's had a lot of the AI fears priced in, and our view is actually looking not too bad from here as well. So we continue to add, and that was a reasonably solid month. So I'll now pass over to John for the Trans-Tasman Fund.
Yeah, thanks, Dave. So looking at Trans-Tasman, again, looking at the Aussie reporting season, similar story to New Zealand, really. Again, beats 46%, misses 30%. So again, what would be seen as a pretty solid reporting season. The chart on the right is quite interesting. I mean, this is essentially looking at volatility on earnings day, and again, looking over almost 18 years to where we are. But you know what it sort of shows is that even on the positive side, you know, we had a material number of green, i.e. stocks moving more than 10% on their results day up. But even sort of more startling was the number of greater than 10% down moves during the reporting season. So a lot of volatility, and again, you know, a number of big moves on the day, you know, exacerbated by, you know, basically macro concerns and sort of particularly concerns about AI. If we look at the performance of the fund, really driven by a few things. Again, Dave's mentioned Ryman and Somerset and the retirement side of things, which broadly netted out. I suppose the good news came from Amcor, where you know, this is a stock which has come under a lot of earnings pressure. You know, the slightly disappointing thing was that volumes still remain negative and under pressure. You know, off 1 to 2%, having been off 3% previously, but this is part of destocking and raises sort of slight concerns about consumer and what consumers spending on staples. But there was improvement on that side of things, and certainly a view that things will get better over the next 6-12 months. But more importantly, Amcor's earnings are fundamentally driven by cost out and synergies from the big Berry transaction that they announced and undertook about a year ago or 6 months ago. And we are starting to see the synergies of that transaction coming through, largely through purchasing and economies of scale. But we're looking to take, you know, 250 million of cost out of the business on that, and we are well on track to delivering. And hence, I think that was well received, and the stock did pretty well. On the negative side of the ledger, probably worth talking about WiseTech. Again, you know, unfortunately, it's been caught up in this theme of negative sentiments towards AI, and AI actually weighed on the stock, even though there was a bounce post the results. But we did get a number of positives out of the results themselves. Again, you know, starting off with a negative, interesting enough, cargo-wise, the core business was growing at 10%, but, you know, below their guidance and expectation of 15%. But again, we are at the early stages of the rollout of a new pricing system. And again, it's just taking time to get people on board. Certainly the smaller end of town is already there, but the bigger end of the town just takes a little bit longer. Nothing terminal there, just, you know, a little bit slower than had been hoped. But more importantly, you know, we are bedding down the E2open acquisition. And again, you know, management did make a pretty firm point that AI is basically an enabler for them rather than a risk. And at the result, they basically said, we're going to halve our research and development capability over the next couple of years, taking about 200 million of cost out of a business which is currently delivering 500 million of EBITDA. So massive potential benefit from taking cost out. And again, you know, this is a business which is highly entrenched in individual regions and countries. first of all, tied into the transport system, but also into customs and ports and borders and things like that. And so, it has a very good system. It's added, a business in E2Open, which takes it sort of onto the water. But with that sort of mechanism already there in that ecosystem, I think AI does allow them to take a significant amount of cost out going forward. And that was clearly good news. Obviously, when we look at IT and software, there are a number of key questions we ask. In particular, do these companies own their own data? Are they a trusted intermediary, and do they have a moat? And I think the answer for WiseTech on all three of these is yes. And then the next sort of important question is, well, what are we willing to pay for an AI software name at the moment? The reality is we're paying 26 times EV/EBITDA for WiseTech today. Noting that the 5-year average multiple has been 50 times, so it's half what it used to be. And again, the interesting thing is if we assume that that is the right multiple to pay for an IT software name, and then we flick to looking at the earnings growth, our sort of base case earnings going forward sees probably about 50% upside potential to the share price. And again, if we do think that AI materially benefits and allows them to raise margins higher or grow faster than we expect, this thing could double. Even on consensus expectations, we're thinking that certainly the underlying earnings grow 25% from here. And so we think, we've been adding to that name within the fund. Moving across to the property fund. Property sector suffered both sides of the Tasman, which was interesting in the sense that it was a month where we did get falling yields. But the rate-sensitive property sector still fell relative, albeit not materially. We did get a mini reporting season in New Zealand and quite a few sets of results in Australia. And again, the interesting thing, we had Precinct, Vital Healthcare, PFI and Winton in New Zealand. And for the most part, they delivered solid results. Certainly, again, key takeaways were valuations have troughed, transactions continue, and also we're seeing a little bit of upside to dividends on slightly better than expected underlying free cash flow. In terms of the market segments, office is okay in everywhere outside Wellington. Industrial, there's a little bit of vacancy coming into the system, but we are basically at cyclical lows, so no real concerns there. And then finally, from VHP, we saw the benefits of the internalisation, which was obviously paid for a few months ago. There is still the concern that Northwest is a stock overhang, but fundamentally, it was a solid result again. Conversely, the Australian sector was off about 3.5%. I think a large part of that was due to Goodman Group. Again, it delivered a set of numbers which were ahead of consensus expectations. But I think the disclosure on the DC, leasing up of the DC capacity they are creating was solid, but didn't really give a huge amount of detail at a time when the market was probably peak sensitivity and peak market volatility. So a good Goodman, weighed on the Australian market and also slightly on the fund. Looking at the chart on the right, this is basically the performance of the New Zealand sector over February. Highlights for me that PFI was probably the pick of the bunch in terms of earnings. We got a pretty solid result. Interesting enough, they managed to put up rents at 8%, a combination of underlying CPI plus longer term rates rebasing up to higher levels. And again, they still think they're about 10% under rented going forward. AFO growth was 10%. And again, they nudged up the dividend guidance to 9.05 cents from 8.9, which again was also a positive. There is a lot of development potential in this business. They did highlight sort of 10 to 15 development options. And again, we took a slight positive from this. They're deciding not to kick those off for the time being until they get anchor tenants on board. So again, they are decently sized industrial assets. But, you know, again, being pretty sensible in the sense that they're not spec building. They are waiting to get a major tenant on board before they embark on basically pouring concrete and starting to build. So that was the property fund. As usual, if you have any questions, please drop us an email at info@mintasset.co.nz. Otherwise, we look forward to speaking to you in a month's time. Thank you.